Hello everybody, welcome to series 1 of M&A Demystified. Today we are going to talk about the basic definitions of terms such as merger, acquisition, buyout and hostile takeover. I'm Rekha Devarapalli, an M&A professional, and I'm excited to share my knowledge of M&A with all of you. Let's get started. Colloquially, the term merger is used when two companies of similar size or market value are combining together, and an acquisition is used when one larger company is acquiring a smaller company. However, the legal definition of merger has little to do with size. Legally, in a merger, one company dissolves into another and there is only one surviving entity. And which is a surviving entity is not necessarily dependent on the size or the employee base, but it's usually guided by tax or other considerations. An acquisition is a transaction when one company, known as the acquirer, purchases the stock or assets of another company referred to as a target company. It is usually referred to either as a stock purchase or an asset purchase. Each has its own advantages and disadvantages, and we'll get into that in a later series. The third type of transaction I want to talk about today is a buyout. A buyout is when a private equity firm such as KKR or Blackstone acquires the assets or equity of a public company and takes it private. The most common form of buyout is known as leveraged buyout or LBO. An LBO is where a private equity firm uses borrowed money to purchase the assets or equity of the target. The best way to understand this is to think of you purchasing a rental investment property, wherein you put in 20% equity and take a loan to buy the rental property and then use the rent to pay back the debt. So in this case, the private equity firm would use the target's cash flows to pay back the debt. So you can imagine the burden this places on the target. The other types of buyouts are management buyouts or employee buyouts, wherein the management or the employees come together to purchase the stock of the company. One of the most famous LBOs in history is that of a food and tobacco company, RJR Nabisco, back in the 1980s. There is a famous book and a movie on this called Barbarians at the Gate. Highly recommend if you have not read or seen it before. A more recent example of an LBO is when Michael Dell and Silver Lake Partners took Dell private back in 2013. The last topic we're going to talk about today is hostile takeover. Hostile takeover is one where a buyer is interested, but the board or the management of the target company is not interested in the deal. However, in case of public companies, the buyer can still bypass the board and management and directly reach over to the target's shareholders. One way to do this is through a tender offer in which the buyer can offer a premium to the current share price in a bid to encourage existing shareholders to sell. Another option is through proxy fight, in which the buyer attempts to have the shareholders vote out certain members of the board or the management in an attempt to get approval for the transaction. However, none of this is easy, and the target company has its own defenses against such hostile takeovers with mechanisms such as poison pill, golden parachute, essentially techniques to make the transaction prohibitively expensive. However, there are examples of hostile takeovers in the past. Some famous ones are Kraft Foods' takeover of Cadbury, Britain's top confectionery food company, back in 2009, and InBev's takeover of Anheuser-Busch, an iconic American beer company, back in 2008. If you want to learn more about this, feel free to check out these transactions. Another great resource to learn about M&A is a book called The Art of M&A by Alexandra Reed. Hope you have enjoyed the video. If you want to learn more about M&A, stay tuned for the upcoming series. Thank you and have a great day.